Greetings, Ed Yardeni here. Thank you for joining me. Let me just straighten out the screen a little bit here. Well, today is March 21, 2022. How time does fly. Never a dull moment in our business, certainly. We started out in January with the markets getting all concerned about the Fed tightening more aggressively. There were lots of discussions about how many rate hikes would actually occur. And sure enough, the Fed did as expected and did in fact raise the Fed funds rate by 25 basis points. The Fed chair, Jerome Powell, gave us a press conference in which he made it fairly clear that we have more rate hikes ahead of us. He was ambiguous about when the next one would be. He said, the upcoming meeting. I mean, clearly the markets are expecting basically 25 basis points per FOMC meeting through the end of the year. The 2 years at a little over 2%. So it's clearly anticipating more Fed tightening. And this time around, oh, there's one of my puppies there. This time around, the Fed isn't likely to back off. Previously, we discussed that there have been 3 previous taper tantrums prior to the one in January, and that in the previous 3, May 2013, late 2015, early 2016, and then 2018, the markets had a tapering tantrum, and the Fed backed off because inflation wasn't a problem, and they could do it, and the economy wasn't all that red hot. This time around, the labor market is exactly what the Fed wished for. It's red hot, and the problem is inflation is even hotter, and so the Fed really has no choice but to proceed with tightening. The market is getting used to the idea, clearly. I mean, we did have a correction in the market, maybe starting January 3rd of this year, down to, I think it was about March 8th. There was about a 65-day correction, and all told, there was a 13% decline. I think it's over. I think that was panic attack number 74. 73 was kind of the initial reaction was to the Fed tightening, and then panic attack 74 was the invasion of Ukraine by Russia. Now, obviously, that situation is still very much an issue. The FT on Sunday printed a report in which he said that the Russians and the Ukrainians are negotiating for a ceasefire and maybe some sort of peace agreement in, I guess it's Istanbul in Turkey. They didn't say exactly where, but Turkey and Israel are apparently mediating this hopeful ceasefire, hopeful peace agreement. And according to the FT, here's the key points that they're making progress on. One is that the Ukrainians will declare their neutrality and abandon their drive for NATO membership. 2 is demilitarization of Ukraine in exchange for collective security guarantees. 3 is what Russia calls denazification. And 4 is lifting restrictions on the use of Russian in Ukraine. I mean, if that's really the main points that they're trying to get an agreement on, I don't know why those things couldn't have been resolved without an invasion, without this horrible deaths and destruction that we're seeing in the Ukraine. But the whole thing is just horrible and bizarre. But it is what it is, and the markets, I think, have increasingly been hoping, discounting, thinking about the possibility that this will end sooner rather than later. What won't end is the deglobalization that has been occurring for a while. I think deglobalization started with the Trump trade wars in 2018, 2019. Then the COVID pandemic clearly led to lockdowns and major problems with global supply chains. And now we've got this war situation in Ukraine. And over it all, there's been an intensifying Cold War between the United States and China, which really got started under Trump. But it's not that Trump started it. Trump recognized that the Chinese hadn't been playing according to the rules when they joined the World Trade Organization back in December 2001. Everybody was overjoyed that they signed up and would follow the rules of global trade, which are basically liberal in their nature, basically consistent with property rights, intellectual property rights, free and fair trade, and all that. But as we know, there's the ideal, and then there's the reality, and the reality turned out to be quite disappointing in terms of how China gamed the system. But anyways, deglobalization is an issue here. As you know, for many years, really since the early 80s, I've been arguing that there are four deflationary forces, the four Ds, and that one of the major forces is détente, globalization. And that's clearly coming under attack here. And we've seen that instead of being deflationary now, deglobalization has clearly had, at least in the short term, some very inflationary consequences in terms of supply chains. The whole world's supply chains were built on this idea of just-in-time inventory management, and that didn't work out too well as a result of the pandemic. And now, as a result of the Ukraine crisis, we will continue to have all sorts of issues with the supply chains. I think this does imply that with all these events that have occurred in recent years, that companies probably got the message by now that it's time to bring supply chains closer to home, geographically, politically, more consistent, put production where you will on a global basis, but try to stay away from autocratic, centrally planned economies. Easier said than done, but the world does seem to be splitting, at least for now, between countries that nominally seem to be democracies and those that clearly are autocracies. But we're still trading with China, and that'll probably continue. I can't imagine that we're going to cut off trade with China the way we're cutting it off with Russia, but this has all been a wake-up call. Now, much of what I just said really is top of my mind, because I just wrote about it for the morning briefing for tomorrow, which many of you will get an advanced copy this afternoon. In terms of today's morning briefing, which you got this morning, or an advanced copy yesterday, a few topics that I covered. One is the tug-of-war that we're seeing in many areas relating to the financial markets. And then I wrote a fairly long piece kind of updating my thoughts on modern monetary theory. With regards to the tug-of-war, let's go and have a look here at the charts. We'll share. Sharing is caring. And here we go. So today is March 21st. Here's the charts. And let's, what I want to kind of talk about is this tug-of-war between the bulls and the bears in the stock market. I think it's going to continue. I think it's going to mean that the market remains volatile for a while. I hope you'll forgive me for being giving you such a wide forecast of possibilities here. But just a couple of days ago, we were around 4,400 on the S&P 500. We're still right, basically around there. I can see the market continuing to be volatile and maybe plus minus 200 basis points. But in writing, I put plus minus 400 basis points. I wanted to give myself some leeway for the crazy times we live in. But basically a volatile market where we'll have some pretty significant rallies. I wouldn't describe those as bear market rallies, nor would I describe sell-offs as a bull market sell-offs. I think it's just going to be sideways action for a while here. And the tug-of-war, I think, starts with the Fed put versus the CFO put. I don't think we have the Fed put anymore. Again, even if the markets had a tapering tantrum anytime soon, I think the Fed would have to basically ignore it. The Fed's main concern at this point has got to be inflation. I think they do have concerns about financial stability and the markets operating properly. But I think they feel that it's not their job to reduce volatility in the marketplace. It's just as long as the markets are working, it doesn't really matter much to them whether it's going up or down. So we don't have the Fed put anymore, but we do have the CFO put. The CFO put posits that corporations are sitting just on a bunch of cash and generating a bunch of cash. So the Federal Reserve publishes data on non-financial corporate income statements and balance sheets. And a couple of years ago, they completely revised their measure for liquid assets. And for some bizarre reason, they actually include equities and mutual fund shares held by companies. They really broadened out the definition of liquid assets. But I look at that, and I also look at what the liquid assets look like, excluding that category. And either way, companies are sitting on trillions of dollars of liquid assets. And you can see that excluding equities and mutual fund shares, there's been a really big increase here in liquid assets during the pandemic. So maybe that's all cautionary balances, and companies want to make sure that it stays liquid, or maybe it's available for doing other things opportunistically as they happen. Meanwhile, corporate cash flow, all-time record high. As you can see from the red line. And again, this is coming from the Commerce Department's measure of corporate cash flow. So it's retained earnings plus economic depreciation. By the way, I'm always amazed how progressive economists point out that all the profits are being spent on buybacks and dividends, and they don't seem to appreciate that it's corporate cash flow that matters when you're thinking about corporate finance. And a big component of corporate cash flow comes from the tax shelter that is tax reported depreciation. So there's plenty of cash flow. It's all-time record high, and it's more than enough not only for buybacks and dividends, but for capital spending. But back to the story here. Here's the buybacks, and that data just came out a few days ago, and you can see that the fourth quarter numbers times 4, just to annualize it a simple way, all-time record high of over $1 trillion at an annual rate. And if you take the 4-quarter sum, you'll see, I was just looking at the Q&A just to make sure nobody's telling me that you're not hearing me or seeing me. But if you look at the 4-quarter sum, you'll see that that's also at a record high of over $800 billion. Now, I've been pointing out for quite some time that Joe and I have been pointing out that not all of these buybacks are actually used to reduce the earnings, to increase earnings per share. A significant portion of this is buybacks to offset dilution from employees' stock compensation plans. So it's not, it's a little bit more complicated than people understand when they just look at the buybacks and they figure all of that is being used to boost earnings per share. Some of it is. My off-the-cuff estimate with Joe is about a third of it is actually used for boosting earnings per share, and 2/3 is used for other purposes, mostly to offset dilution. Because when you look at the growth rate of earnings per share versus earnings, we're finding that the difference is only about a percentage point in the growth rate. It's not anywhere near what you would expect if all that money was being used to buy back shares in order to boost earnings per share. But we'll be updating that story shortly. Joe's just waiting for a couple more pieces of data for the S&P 500, and we'll give you an update on that story. Dividends, all-time record high as well for the S&P 500, whether you look at it the quarterly times 4 or the 4-quarter numbers. So a tremendous amount of cash going back into the marketplace, assumption being that a good portion of the dividends are in fact used to buy more stock. So here we go. The stock market, in our humble opinion, is probably going to continue to move sideways here from the roughly 4,800 high that we made at the beginning of the year. It was 47.92, I think. And then I guess we got down to about a little under 4,200. Just 4,000 is certainly a possibility as we, depending on how the war goes, and also depending on whether the Fed decides to get a little bit more aggressive about inflation. What's changed for us as a result of the war and as a result of just watching the data is the inflation situation has gotten worse. It looks like it's going to be longer for longer. Let's do that again. It looks like it's going to be higher for longer, and that being the case, that is likely to have more of a downside impact on valuation multiples. Meanwhile, there's a tug of war here between people looking at the yield curve. Some people are looking at this yield curve, which is the official one and the leading economic indicators, and it's the difference between the 10-year and the Fed funds rate. And the Fed funds rate takes a while. It's administered. It's decided by a committee. But you can see that there's a pretty decent pattern in this version of the yield curve. And if the pattern were to repeat itself, then we should be going to something like 350 basis points between the Fed funds rate and the 10-year. And we know that the Fed funds rate is going to go probably to 1% by the end of the year, maybe 2% by the end of next year. That would imply much higher bond yields than what we have right now. But then again, I think there's a perception that we may not get to 2%, maybe 1% is about as much as we're going to go. And maybe the yield curve will start to invert where the 10-year won't get to this kind of spread, but we may already start to see some narrowing of the spread, particularly in the 10 versus 2-year. But the yield curve, as I've said before, tends to anticipate that if the Fed continues to tighten, and now this red shade means that we're in tightening mode, that at some point something's going to blow up. You can see all these financial crises that have occurred during tightening periods, and then they become widespread credit crunches, would then become recessions. But right now, if you look at this yield curve, what's the problem? There's no recession in this yield curve. Well, let's skip a little bit here and look at this. That yield curve that we just looked at, the 10 versus the Fed funds rate, is one of the 10 components of leading economic indicators. And as you can see, there's no recession in that either. It actually dipped a little bit in January and came back in February, but it remains near a record high. So no recession there. Where the tug of war is occurring is some people are looking at the other side of another part of the yield curve, which is the 10 versus 2, and they're very concerned about that. And am I concerned about it? Sure, I am. I mean, it does have a record of anticipating credit crunches and financial crises and recessions. We only have the data back to 76, but it's got a track record of doing that, and it's more market oriented than the 10 versus the Fed funds rate. So it is something to worry about. Before the Ukraine crisis, I think the consensus view, my view as well, was that it's hard to see what was going to cause a credit crunch or recession. But then we had the spike in oil prices, the spike in commodity prices. Consumer confidence is down because inflation is depressing a lot of people. And so it's not out of the realm of possibilities, clearly. There's an increased chance. If there's a chance of a recession, if you want me to put a number on it, it was like 5–10%. Before Ukraine, I would now say 25%. And again, it's not just all the Ukraine crisis. Part of it is that the inflation situation is turning out to be more troublesome. There's more of a wage price spiral going on and so forth. MMT, I'll let you look at what I wrote on it. I've written about MMT before. This time I'm kind of declaring that MMT had a great run for a short while, and now it's been discredited by the fact that they promised us that the Treasury could spend as much as it wanted to create full employment and to bring prosperity to all and enjoyment to all in the land, and that wouldn't be inflationary. But if it was inflationary, the MMTers said we could use tax policy to sort of target where the inflation problems are. Well, clearly that's not the way things are playing out. Even the Fed kind of got into that by deluding themselves and us that they had a whole bunch of tools in their toolkit for dealing with inflation. And the reality is there really is only one tool that I know of to bring down inflation, and that's to cause a recession. So if you look at this chart, which I skipped before, that's the CPI inflation rate going all the way back to 1921. And it's pretty obvious that what brings inflation down is recessions. Fed Chair Powell in his press conference said that the goal that the Fed has is to gradually raise interest rates to gradually slow demand to bring it in line with supply, and that would gradually moderate inflation. Good luck with that is all I can say. So having said all that, why don't I stop sharing so I can see you, or you can see me better. And then let me go to the questions here. Doug, why do you think the Fed is still buying MBS in spite of the red hot housing market? And do you think another housing price pullback is possible after they do stop buying MBS and keep raising rates? Great question. It's not even clear why they've been buying MBSs for the past year or two. Home prices are up 33.4% on a 2-year basis when you look at the median existing home price through February. So it's been a monstrous appreciation in home values, more than we had not even close to, well exceeding, I should say, what we had back in 2006, 7, and 8. So go figure. They kept saying that this QE was designed to stabilize financial markets, and they just kind of deluded themselves into thinking that QE had a legitimate purpose, which it really didn't in the face of the tremendous increase in inflation. I mean, MMT, modern monetary theory, got implemented on the week of March 23rd. On Monday, the Fed did QE forever, and on Friday, the fiscal authorities came in with the CARES Act. And it worked like a charm for about a year. And then it started to be clear in March, April of last year that inflation was starting to pick up. As you know, first it was the base effect, then it was transitory. Now it's the Ukraine war. Well, it's becoming pernicious, persistent, and pesky, and all the P words you can come up with. It's a pain. Came up with another one, but I don't know. I think they've got to stop buying MBSs. It makes absolutely no sense. I think that we've already seen the markets anticipating that. We've seen mortgage yields rising quite substantially here. So we could see that the best cure for high prices in the housing market, same thing as they say in commodity markets, the best cure for high prices is high prices and higher mortgage rates, and that's bound to create some stop the appreciation that we've seen in home prices and could actually start to bring them down. I don't think it would have the damaging impact that it had in 2008, but it could certainly take some of the wealth effect that people have been enjoying, figuring we're making a lot of money in housing. I mean, 33% in 2 years is an awfully good rate of return that you're not going to find in too many other assets. The problem is if you try to sell it, you got to have someplace to move to, and buying a smaller unit is hard because they don't exist. There are not too many of them out there. The market's very thin. And then renting is turning out to be a very expensive proposition if you can find something that's that you can live in. Anonymous. I hope that's not the same Anonymous that's attacking Russia, but they're doing a good job finally being on the right side of history. Can you remind us of the other 3Ds? Yeah, so I won't go into the whole thing, but I'll just remind you that the first one is globalization, which starts with a G, so let's call it détente. Peace times tend to be periods when global trade flourishes, where national economies integrate, and that creates global competition. You can go to where cheaper labor markets are, and that's tends to be deflationary. And then we have technology, which starts with a T, so let's call it disruption, technological disruption. I think it's pretty clear that technology solves problems, and one of the big problems in economies is shortages and rising prices. Well, technology deals with that. They don't teach that in economics. In economics, we're taught that economics is all about how to distribute scarce resources optimally. And my view is that that's not what economics is about. It's about how technology and how entrepreneurs come up with solutions to scarce resources to lower prices, and they create deflation. Then there's demography, which starts with a D. The idea being that geriatric demographic profiles are inherently deflationary. Older people don't tend to be as inflation prone in their behavior, consumption behavior, living styles as the younger people with families. There's only one real problem with that idea, and that there is another way to argue it. And there's been a couple of economists that have written a book saying that actually the labor shortages that we're seeing here, because fertility rates have collapsed, are inflationary because they're leading to higher wages. So I agree with both sides of the argument, though I've been arguing that the geriatric aspect has been trumping the other side. But I have to concede that right now, in terms of what the data is showing, the data is clearly showing that labor shortages are leading to higher wages are leading to higher prices. And it's not just the wage price spiral, as I've pointed out of late, it's the wage price rent spiral. Melissa's done a lot of good work on that. So that's where we're at there. And then finally, debt. We're taught in economics, if you want to stimulate an economy, lower interest rates, make credit conditions easy, people will borrow, they'll buy it. What they might have bought in the future, they'll buy it today, and you'll stimulate the economy. The only problem is if you've been doing it for a couple of decades, as the central bankers have, it becomes less and less effective. And if, as it becomes less effective, you lower interest rates and provide more credit trying to stimulate demand, what you get is more supply, because zombie companies have the access to cheap credit, and you get more deflation. So those are the 4 Ds. And I'd say deglobalization now, I have to maybe come up with four alternatives, but deglobalization is an issue that's coming to the fore. And the demography, as I said, there's another side to that story, which seems to be playing out. Let's move on here. Instead of raising taxes to punish corporations for elevated buybacks and dividends, do you think the argument will shift to change the tax code to lower allowable tax shield via depreciation of fixed assets? Honestly, I don't think anything is going to happen here through midterms. And then ask me again. Let's see what Congress looks like. Yeah, I mean, progressive politicians and economists have been chomping at the bit to put some tax on buybacks. But that was part of the Build Back Better plan that it was probably going to be like a 5,000-page legislative extravaganza. And it was going to include all kinds of things like some small, I think it was only going to be a 1% tax on buybacks, but I think that was just to open the door on doing something like that. So for now, I think buybacks are pretty much, the environment doesn't really change in terms of what companies can do. Laura, hello. What are the companies you think they will go to purchase their stocks? Well, in terms, if you're asking me about which companies, which sectors are seeing the most buybacks, it's pretty widespread actually. It's, companies have a tremendous amount of cash. Some of them are back to giving out compensation in stock, and to reduce the dilution impact are buying back shares for that purpose. And others are just buying back shares because they've got a tremendous amount of cash, and it's a great way to boost their earnings per share. Where do you see the 10-year Treasury peaking out, and when? Let me I'll answer that in 1 second. I just want to pull up some more questions here. Yeah, so good question. I don't know. I'm thinking that we'll see 2.5% on the 10-year by the end of the year, or the way things are going, sooner. Until recently, all my forecasts were later, because the bond market was taking sweet time getting to where I thought it needed to be. I think that we have to deal with the fact that bond yields are still near zero in Japan and Germany, and there's some arbitraging going on between those two markets. I would say that the peak in the bond yield could be at the end of this year or early next year. But tune into the Monday webinars, and we'll try to address that on a regular basis, or ask me if I don't. Jim, let's see, Christian, What leading indicators do you focus on to indicate how the consumer is reacting to inflation? Well, I think one of the better ones is actually the consumer sentiment index. There's two indexes of consumer confidence. There's the consumer confidence index, which tends to work pretty well, tends to be very sensitive to the labor market, and things are great. And so it's held up pretty well, but it has been eroded somewhat by the inflation the consumers are seeing. I mean, consumers are saying, oh, great, I got a nice big wage increase. And then they go to the store and say, it's not buying me any more than that I had before. And in some cases, less so. So I think we are seeing a situation here where consumer confidence is getting beat up on the inflation side. And you can clearly see that in the consumer sentiment index, which seems to be much more sensitive to inflation. We have those charts on the website. You can have a look when you have time, or remind me next week, and when I have time, I'll show you on the website. Let's see here. I'll take a couple more. How much weight do you give to the position that Fed policy is not suited to address supply side constraints like COVID-related labor shortages and supply chain disruptions and war-related commodity price shocks? I mean, it's a good point. And I think it goes back to the idea that the only way that Fed policy can really bring down inflation is to cause a recession. You really have to depress demand relative to supply. You have to really see unemployment go up to really get wage inflation down and to get price inflation down. If you just do this gradual approach, it's been tried before, it just doesn't work. And especially in an environment, which you, in your question, correctly point out, there are just inflationary issues that are really not ones that the Fed can address, as you ably pointed out in your question. Let me take one more here. Now that the Fed has made their announcement, do you still like financials? Yeah, the answer is yes. I still like energy as a hedge against inflation, financials as a hedge against rising interest rates, and I still like technology, particularly some of the ones that have been beat up, or certainly the ones that have earnings, let's put it that way, and will be essential in terms of increasing productivity, which I still think is a valid scenario once we get past through this scenario that feels very much like the great inflation of the 1970s, but I don't think that's the way the decade's going to play out. I think it's going to play out with technological revolution, boosting productivity and allowing real wages to go up, which will bring inflation down over time. I'll take one more from my good friend Vincenzo. Vincenzo, the bull-bear ratio went to buy zone. Do you think that was the low for the market? Yeah, I mean, it's got a great, the bull-bear ratio with Investors Intelligence has got a great track record of telling you to buy whenever it's 1.0 or less. That doesn't mean that the market hasn't in the past sometimes continued to go down a little bit, but it's turned out to be a really good buy signal. So I would say that from a sentiment standpoint, we probably have, we came pretty close to a low, but again, things are just so crazy in the world. I felt had to make sort of a wide range here in terms of volatility, and calling for 4,800 to the top, 4,000 for the bottom. But let's just put it this way. I don't think we're going to be making a new high this year, but I think we will be making new highs next year. So still bullish about the trend for the market. Well, you were all very kind to join in, and let's do this again next week. All the best. Have a good week.